So welcome everyone. We might make a start. My name's Tom Misha, I'm Research Director at CRC Time, and it's a great pleasure to be introducing the webinar today. Eric, if you want to just bring up the slides and we can make a start. What I might do is while you're getting that ready, sharing those slides, is provide an acknowledgement of the country in which we're on around the country. For me, that's the Jagera and Turrbal people, and I'd like to extend that acknowledgement to all the country and all the places where we're all from today. We will be moving ahead just shortly. Before we get started, I will mention that we will be recording today, and I'm going to introduce Eric. So Eric is an engineer and he's a minerals and energy economist. He lectures in the Masters of Minerals and Energy Economics program at Curtin University. And he also has extensive experience in the industry and has had roles in mining and finance and been the managing director and CEO of companies. And also particularly interesting, he's been on panels of experts for the IMF and for the World Bank. So it's a great pleasure to be introducing Eric for this webinar. And over to you, Eric.
Thanks very much, Tom, and good morning or good evening, wherever you are in the world. I'm sure most of you are in Australia. So yeah, I've been working on this whole idea around valuations, valuation philosophies and methodologies for probably more than 30, 40 years, including in my days in investment banking. And this specific aspect we're looking at here, I've got the title on the board as an exercise that I completed for CRC Time towards the end of 2023. And it looks to the limitations and issues surrounding this kind of cash flow net present value for mine closure and post-mine closure. Now, that is obviously the specific theme, the mine closure, post-mine closure, but keep in mind that some of what I'm going to be saying actually provides the various limitations and downright errors in using DCF NPV across a mine cycle, a mine life cycle, not just associated with mine closure and post-mine closure, but obviously that is the emphasis. So before we get into that, Tom, thanks for acknowledging country. I have just got a slide up here that does acknowledge country, and I have specifically left out the specific locales simply because I think everyone on the call is spread right around the country. So I'm sitting on Whadjuk Noongar Nation ground, but I will extend my thanks and my appreciation and respect to elders past and present for a wider community rather than just where I'm situated. You've already heard a little bit about who I am and what I am. Yep, and if you have to listen to my entire CV, you'd probably think that I'm about 117 years old. Sometimes I feel like I'm pretty close to that. Right, let's get into it. What are we looking at? So essentially, what I was tasked with having a look at a number of questions, or I posed a number of questions for my specific research piece. And I've listed 7 key questions here. You know, can we rely on the discounted cash flow method and associate NPV tool for mining valuations? That's sort of a generic question on, does the approach and methodology, DCF, the cash flow is an approach, the NPV is the methodology, can you actually look at relying on it? What about when you look specifically at closure, post-closure analysis? And we know that closure, post-closure, we're typically looking at cost and benefit. What about the aspects of the tool, in other words, DCF NPV, that is actually useful, that it does generate dependable results? So as I say, I'm not here to try and just castigate or shoot down what DCF NPV doesn't do. It has got its benefits, otherwise we wouldn't be using it at all. And you know, what parts of it can we actually trust with fair certainty? With that, we have to look at the negatives. What are the issues surrounding relying on the tool? And then what are the limitations and, unfortunately, the outright errors? There are some outright errors that are associated with DCF NPV. We'll have a look at those. Then what are the challenges incorporated in things like market risk when you're using DCF NPV, or geological uncertainty, ESG, etc., when you feed those into an analysis? And then probably a number of you are saying, well, that's all fine and well, you go shoot down a method, but it's a bit pointless in research if you don't actually then say, well, what could we use an alternative? Now, just on the slide I've thrown up, I've said, you know, maybe we can use Monte Carlo risk simulation. decoupled NPV. Unfortunately, that question, I'm going to suggest that they provide their own challenges, but I'm not going to go into the details of what those challenges are. I'll give you an overview in general. But then I will come up with some alternatives as well. So hold on to your hats until we get there. Looking at those 7 questions. So can we rely on the DCF method and associated NPV tools for mine closure? Well, quite simply and simplistically, no. That's quite an easy statement. Notably for life of mine valuations, and part of the reason, we'll go through all of the reasons, we'll elucidate those over the next approximately 30 minutes that I'll be presenting, and then obviously questions, answers thereafter. We have your normative issues, and some of these issues are around the forecasting, things like our prices, our exchange rates, the various tons, grades, cost, capex, discount rates, etc., for your longer life assets. Of course, for shorter life, we're not too concerned about shorter life because we tend to have a far better idea of what will happen next week, next month, next year. But when you start looking at 5 years' time, 10 years' time, or longer life assets plus 20 years, our knowledge of what prices and markets might be doing, our grades, what we're mining next, what our cut-off grades are, which then is impacted by exchange rates and commodity prices. So these are some of the complications that kick in and start rendering the methodology questionable as far as the results are concerned. Of course, when you talk about mine closure, post-closure, what about under those specific circumstances? Well, if I've just said that, no, it's DCF NPV is not that accurate for mining in general, well, then I can tell you emphatically it's absolutely not appropriate for mine closure, post-closure. And part of the reason is because closure, post-closure are typically associated with expenditures, post-closure expenditures. There is often a bit of income as well associated with it, but all we're doing is we are looking at these closure, post-closure occurrences, and then we discount them. That's what your DCF NPV is doing. And we're discounting over time, which we know introduces accuracies. And I'll go into some of the detail around those inaccuracies, notably with what discount rates are supposed to do, and actually what practitioners are using discount rates for. And they are 2 separate things. And I'll tell you right now, not very accurate at all. I said that there are some dependable results, DCF NPV, we're not going to shoot it down from every possible level. Well, we know that the economics associated with the methodology, in other words, the mathematics behind it, we're pretty comfortable. We've been evolving it and developing it over many, many decades. So we're pretty comfortable that it is an accurate methodology from a short-term point of view. Now, keep in mind, DCF NPV was introduced somewhere around 1970s, but it was never introduced for mining operations or for mining assets or for anything associated with natural resources, because natural resources have got their own idiosyncrasies as far as technical and techno-economic parameters are concerned. So DCF NPV was actually introduced that many years ago, I'd say 60, 70, 80 odd years ago, to largely value things like financial companies or widget producing companies that are pretty stable in terms of what they're producing at what point in time, how, when, rates, etc., etc. There's another aspect, of course, that's pretty positive. Cash flows that factor in your commodity prices, things like including your costs, your capex, royalties, etc. They're dependable over very short periods of time. So as I just said, if you're forecasting for a week or a month or a quarter or a biannual period or a year or maybe up to 5 years, yeah, you can pretty much trust DCF NPV to give you a fairly accurate guide on what the value may or may not be. Beyond that, what you do is you start compounding the uncertainties, and we'll get onto that as well. We also know that for short period, and you might say, well, hang on, over a long period, we can actually look at sensitivity analyses or maybe Monte Carlo simulations to try and give us a better feel, or we can have a look at an ROI, return on investment, including internal rates of return. And don't they give us a guide? Yeah, it's a guide, but they're not that great. Now you see on the slide, I've actually highlighted cutoff grades. Cutoff grades is a critical parameter within the resources sector, notably within mining, that throws up all sorts of challenges. And you might say, well, why does it do that? Part of the reason is keep in mind that when you design a life of mine plan, you use a certain parameter or use the specific parameters at a point in time that look to your commodity price and your exchange rate, because most commodities are priced in US dollars. So you're going to look at the exchange rate as well. On the basis of what those economic parameters are on your pricing, local pricing, you then determine a cut-off grade. And your cut-off grade is the grade at which your company can generate the required return to make it feasible to actually operate. So you've got a return of investment built into the cut-off grade, and that makes it feasible. You can imagine that if you've got something like an ad valorem royalty, it impacts cut-off grades, because an ad valorem royalty is going to take off your revenue line, which means that you are going to have inadvertently increased your costs, which means that your returns are going to reduce. So you'd have to increase your cut-off grade to get the same kind of return if someone introduces something like an ad valorem royalty. This goes to the same tune that if I change my operating cost, if I increase my operating cost, which might happen over time, or I run a sensitivity, what's it going to do to my cut-off grade? This is an important point because DCF NPV is not integrated with any other planning tool, typically, that allows for automatic variation on redetermining cutoff grades. And bear in mind, again, the moment you change your cutoff grade, you're changing the life of mine of your operation. So your closure, post-closure, is going to be brought forward or pushed back, depending on what happens with your cutoff grade. That's why it's important to give it due consideration in this context. Then, of course, one of the things that a lot of people forget is that when we talk about returns, when we look at DCF NPV and ROIs or IRRs, we're looking at returns to a company, not necessarily to you as an investor. Because keep in mind, you've got your own tax base and you might do an investment into a stock that's listed on a stock exchange. That stock has an underlying asset. That underlying asset has a corporate tax rate. But by the time the money or the return gets to you and you get either a corporate return, in other words, an equity return, or you get an income return, which in terms of a dividend, you've got your own tax rate. And yes, you might say, but hang on, I've got a franking credit. Yeah, but there's a difference between 30% tax rate for a franking credit and your personal tax rate, which might be above 40%. So again, please keep in mind, what are you looking at in terms of using these techniques or this particular technique for valuation? We want to talk about valuation of an asset. So some of the other issues associated with relying on the tool. Well, one of the problems that we do have, and it's quite a significant problem, is that using the tool like this, actually it drives behavior. We develop a discounted cash flow NPV model, and we look at the results as if it's the holy grail, and we say, oh, this is going to affect how we actually go about addressing closure, post-closure. It starts driving behavior. So it's, the cart and the horse, which is leading what? And it becomes a challenge when you allow for a modeling technique to actually influence and change how you might have behaved otherwise. The other three questions that I'd raised right at the beginning are answered over here. So what are the limitations and outright errors? Well, we all know this: garbage in equals garbage out. If you haven't got adequate and well-supported inputs into a DCF NPV, granted, and be concerned, I suppose, that your output is just going to be just as rubbish. So garbage in equals garbage out. Your economic variations, things like your prices, cost, capex, taxes, etc. I mentioned how they impact your cutoff grade, but the DCF NPV model doesn't actually allow for variations. What it does do, it allows for a re-evaluation of your model in a year's time or 2 years' time or 3 years' time. And you're going to keep on updating your DCF NPV model as you get closer and closer to mine closure. But while you run your sensitivities, Monte Carlos, etc., you're not changing your cutoff grades. So you're actually modeling, truthfully, you're modeling garbage. Discount rates. This is really, I wouldn't say contentious, but I'm going to state quite categorically, most people get discount rates totally incorrect. What often happens is your practitioners, your valuation professionals or practitioners typically use a static discount rate. In other words, they say that, as we're heading over a mine life all the way to mine closure, we are going to use 8% real discount rate. So the first question I always ask is, why is it 8%? Why isn't it 7.95 or 8.23? Whatever. And they say, oh, no, this is the company and the board of directors have said that we need to have an adequate return. So I'm saying, return on what? Surely it's return on your invested capital. So what is the cost of your capital? So when you look at your discount rate, surely you should split it into your weighted average cost of capital, which is the cost of debt and your cost of equity, and then Only after that consider, well, what return do you want above your cost of capital? But companies don't do that. Some companies say, oh, no, we do that. We definitely do that. But then I have to ask the question, well, then do you use variable discounting? I say, well, what's that? Well, that allows for a discount rate to vary over time, because keep in mind that in your capital asset pricing model and your cost of debt, and by the way, there should be a cost of pref shares in there too, but we often don't use pref shares, preferential shares. There's a separate cost to that. So we use cost of debt, cost of equity. What happens to debt over time? Well, either you repay and you reduce your debt to zero. So surely your cost of debt has to diminish to zero at a point in time. Or the company might say, well, actually, we have a targeted gearing ratio. So we have a targeted gearing over the life of our asset of maybe 30%. In other words, according to your capital, you're always going to have about 30% debt on your books. Makes perfect sense from an investment point of view, because debt is cheaper than equity. So try and have a targeted gearing. But what it does do to your discount rate is you might start your company at, say, 60% debt, and over a period of 4 or 5 years, you drop to a 30% debt rate. It means that your cost of capital has actually changed over time, because your weighting has changed, the weighting on your capital. So I'm telling you right now that discount rates are always a mess. What are the challenges in incorporating market risk, geological uncertainty, governance, etc.? Well, qualifying your risks and uncertainties. Then we throw intangibles and intangibles can often be quite a challenge. We know what unknown knowns are, but as soon as we get into unknown knowns, known unknowns, and unknown unknowns, we're sitting in an ether where we haven't got absolute answers. And then we say, oh, we're going to model it anyway. Well, that's almost like that garbage in equals garbage out. So I'll give you some definitions of what I'm talking about in terms of these factors and what some of those challenges are. Outside of that, so we've got a DCF NPV. That's great. So what alternatives can we apply? Let's use Monte Carlo simulation. Let's use decoupled NPV. I'll put a line through decoupled NPV because I'll deal with that next. But we do use decoupled NPV. But Monte Carlo, well, let me give you some ideas of what Monte Carlo is all about. So this sounds like Panis here. Wow, we've got the answer. So who needs to do any more research? Well, Monte Carlo models actually look to the probabilities and the impact on risk and uncertainty. It then averages results. But one of your fundamental issues with the Monte Carlo simulation is that it assumes a perfectly efficient market. Well, I can tell you right now, natural resources is far from a perfect market in any of the trades that we deal in the natural resource sector. So we already have a fundamental problem associated with just dealing or using that technique. I've listed here some of the advantages and disadvantages of Monte Carlo. So Monte Carlo, it helps companies better understand impact of different variables. Oh, yes, it does. It highlights potential scenarios that may not have been considered otherwise. Correct. Yes, it does. It can help investors make informed decisions. Wonderful. How powerful is this? However, the disadvantages. Monte Carlo can be difficult to identify key variables in the first instance. So you don't even know what you're simulating. Your results may be misleading if you have inaccurate variables that are included in the modeling, or if your range of outcomes is too narrow. Also, it's time consuming and often it's expensive because sometimes you cannot access software. So Monte Carlo software can be powerful, but or the use of it can be powerful, but there's a cost to it. And, Excel is free. So DCF NPV modeling tends to be free as it goes with Microsoft. Also, if we apply a Monte Carlo simulation analysis off the base of a DCF model, well, then we've introduced all the DCF limitations in any event. Trying to go one at a time. So what are the potential alternative tools? Now I said, I've looked at Monte Carlo. What about decoupled NPV? Well, first of all, what is a decoupled NPV? Well, all it does, it looks to decoupling your discount rate. It strips out your discount rate and it considers only a risk-free rate. So in other words, in your capital asset pricing model, we look away from the market variability and we only consider our risk-free rate, which is the return on a government bond, all right? It's the yield in a government bond. So the government issues these wonderful things called bonds to raise income for infrastructural development, and then they guarantee you a 3, 4, 5% yield. Well, that yield is actually your risk-free rate. And we want to have a post-tax risk-free rate. Please make sure that it's not a pre-tax because we deal with post-tax cash flows. What that also means is that we don't have a cost of debt sitting in our discount rate, and we don't have the cost of equity sitting in our discount rate, because all we've done is we've taken our risk-free rate and used that as our discount rate. So the decoupling actually allows for your cost of risks to be priced separately. And they're priced into the individual components of your cash flow. If you ask me, that sounds very similar to real options. So I've actually said it here in that second sub-bullet point, that it's very similar to real options. We run options around the inputs, and then we take our discount rate to be our risk-free rate. But your decoupled NPV incorporates risk and risk reduction measures into the project valuations in financial terms. It also looks at the benefits of risk-reducing investments, and then the resilience supposedly be valued according to your project level modeling. Now, what I'm stating here is that even though we are doing all of this, and we've stripped out our cost of debt and stripped out our cost of equity, and we've only got our risk-free rate, I'd love to see this being done by a practitioner accurately. Again, I said, I come with the advantage of having worked 15 years in investment banking. And part of what I did for at least 6 or 7 years is I actually modeled debt profiles for mining companies for one of the investment banks. And I got to understand the intricacies. And believe me, it's not a simple case of just saying, I'm going to strip out the risk-free rate and model the debt. So there's quite a challenge in that. I've thrown a final statement on this page here about what about using derivative instruments to provide more accurate, dependable outputs? And you might be saying, oh boy, here we go, these academics. Let me give you a taste of what I'm talking about towards the end of this, if I've still got your attention. So what else? In this research, what else did we determine? Right, equally applicable to closure and post-closure, because as I said, a lot of what the findings were was applicable to DCF NPV over a mining life cycle. In other words, valuing a mine, not so much as I said in the early stages, in other words, a short term, but in the medium term, long term. And again, keep in mind that in the short term, if you look at something like a definitive feasibility study, I don't know how many of you have actually either conducted one or has actually looked at one. I've run 3 feasibility studies over my time. And again, yes, that's why I'm 117 years old. What you do is the first 1 year, that definitive DFS is actually run on a monthly basis. So you know what tons, what grade, month by month by month for the first year. The next 2 years are run quarterly. So every 3 months, you now have your inputs, outputs. And for the next 2 years after that, to years 4 and 5, you run it biannually. Only from year 6 onwards do you run a DCF model associated with a definitive study on an annual basis. That clearly gives you an indication that we have fair certainty in the first year. We model it monthly. We have adequate knowledge and surety around what our inputs are in the next 2 years because we're modeling quarterly. We know fairly well the next 2 years after that, years 4 and 5, because we're modeling biannually. And beyond that, we're now taking sort of larger steps or bigger guesses to say what's going to happen on an annual basis. Right. So some of the issues that we picked up, the cyclical nature of mining business, it's not taken into account. Long-term effect of sovereign risk. Keep in mind, sovereign risk is a return on the government bond. Well, government bonds change all the time. So how do we take sovereign risk, which is that reflection? How do we factor that into a DCF NPV if we've got no certainty of what the yield is going to be doing over time? Because we're looking at markets all the time. So that's a problem. Of course, it doesn't consider mine closure effects on certain costs like environmental, ESG, climate, wastewater drainage, social, other factors, and what happens over time and what kind of a rate that we're looking at to discount in the DCF NPV. It doesn't take into account geological uncertainty, maybe short-term grade variations, especially towards the end of life, because that's too far out. We don't know what's going to happen. We might be reprocessing waste piles, which have got low grades, and be diluting that with existing material at closure. It also emits variability in our discount rate, and I've discussed that already. Identified limitations as well. End of life date holds so many uncertainties, but we model them as best we can, but we don't even know what they are. Or we know what a lot of, but there's some we don't know. Post-mine land use may not be the optimal use. And maybe there's something to be said, well, what we should be doing is consider mining as actually borrowing the land for a purpose, which is mining. And at the end of that purpose, mining, we take that land back to what it should be used in the longer term. Now, that's a different way of thinking, because then your modeling is not going to dictate behavior. your behavior for mining, which is an interim period using the land for mineral extraction, for wealth creation, etc. But at the end of the life of that mine, that land is going to be taken back to what it was intended in the first instance. We've just leased it for a period of time to extract mineral wealth. What about some of the positives on closure? We always talk about the negatives, that cash outflows, but there are some inflows as well. And some of it could be salvage value, there could be retreatment of whatever, tailings that might still contain mineral, etc., etc. We might use some of these stockpiles, which are too low grade, as aggregate, I don't know, and you generate income. How do we compensate for the unknown knowns, the known unknowns, and the unknown unknowns associated with that? Now, I've included the definitions here just for completeness. So you might say, well, gee, you really are pushing this into far too much depth. But the issue still sits that if you don't know something may or may not be or may not occur at the end of life, at mine closure and post-closure, well, then how are we going about valuing it, quantifying it, qualifying it? How are we actually doing it in a DCF NPV where we don't even know what it is? So I've thrown the definitions up here based upon a paper that I was co-author on. Things like tangible risks, which are known. We know what the risks are, and if they eventuate, we know what to do. We model that. That's DCF NPV. We can do that pretty readily. What about an intangible risk? Well, something's either tangible or it's intangible, and something is either a risk or an uncertainty. So those are your 4 parameters. Now you mix them up and we say, well, we have an intangible risk, and we have an intangible uncertainty, and we have a tangible risk, and we have a tangible uncertainty. And again, I'll let you read through these to get a better understanding of exactly what they are. But you'll see that in the intangible uncertainty, sitting right here, we don't know what that uncertainty is. We don't know what the occurrence might do. We don't know what the outcome might be. Well, gee, that's a bit of a tough one. So how do you go about evaluating that? And that's one of the big challenges that unfortunately DCF NPV cannot do. So I think I've given you a little bit on discount rates, seldom based on accurate cost of capital. There are ways of doing this. I've written papers on how you can separate your weighted average cost of capital and allow for a variable discount effect so that over the long term, your discount rate actually reverts to your risk-free rate of interest. As I said, decoupled NPV looks something not too dissimilar, except they just say that in a decoupled NPV, you start with your risk-free rate. That's the only thing you use, and you model your risk in your cash flows. You can incorporate your WACC variability over time, and you approach that risk-free rate on a post-tax basis. Please keep in mind. The other issue you've got is in your capital asset pricing model, we have this market volatility. So that's called your beta, but it's a relative term. So betas consider variability based upon the market as a whole. So betas vary with the market. They also derive from historical variances, and they reflect a share price volatility. You can't get a beta for an asset unless that asset's listed. But most companies have a holding company that's listed and an underlying asset that's not listed. So then we have to introduce proxies for betas, and then we do some horrible calculations to determine what that beta might actually be for the asset. On top of that, I've mentioned before that a perfect market correlation, in other words, beta equal to 1, not possible. Not now, not ever, because the market comprises something like 200, 300 stocks. And for you to have a mining stock that you think might get a beta of 1, perfect correlation, no, I'm afraid that's a pipe dream, never going to happen. What also happens is that it ignores flexibility. So DCF modeling ignores flexibility. That's why we introduce real options, Monte Carlos, maybe sensitivities, but they also have their own limitations. Some of the limitations, additional limitations. DCF NPVs do not adequately accommodate our intangibles. So modeling, we incorporate the known knowns, as I mentioned, the known unknowns to some extent, but we struggle to incorporate unknown knowns and the unknown unknowns. I've said that it drives behavior, DCF modeling drives behavior, but there are other limitations. Your other limitations are things like commodity prices and exchange rates. As I pointed out, when you build a cash flow model, even looking towards life, end of life, closure, post-closure, what we say is that we have grades or whatever, and we calculate the cutoff based upon a certain parameter associated with what our potential income is going to be. That's all fine and well, but believe me, the first time you run a sensitivity analysis, as long as you have a material change, let's say we run a sensitivity on our operating costs, and we add about, say, 10%. We want to do a sensitivity on plus 10% cost. Well, the reality is that you'll change your cutoff grade. If you increase your cost by 10%, even in the sensitivity, you have to increase your cutoff grade, otherwise your returns are going to diminish. And if your returns are going to be the same at an increased cost, and you increase your cutoff grade, it means your life of mine is going to change. So there I've listed a few factors that really, really make it a challenge. And as I say, they compounded by the fact that you start pushing towards a closure, post-closure scenario. A few more points. DCF NPV. Positives. It's well known, globally recognized. It's simple to use. We don't need a software package. It does accommodate time value of money. That's a positive. It facilitates decision making. Yeah, again, garbage in, garbage up, but it can. You can run sensitivity analyses, understand the limitations. It is useful for real options Monte Carlo, and it does provide a sound base for decoupled NPV. So like I said, I'm not trying to shoot the methodology down in toto. There are positives, but there are some challenges. The logic then says, I've just got a couple of slides there, folks. The challenge then says, well, Eric, that's wonderful. You've told us everything that's wrong. What are the alternatives? And it's easy to say, well, the alternatives, we need to determine an alternative. Well, that's, yeah, fine. We'll go and do it. We need to be able to qualify, quantify mine closure, post-closure. We have to address the issue surrounding poor company behavior. In other words, this whole idea that DCF NPV actually drives behavior, we need some methodology that doesn't drive behavior. We need some alternative techniques, and I'm going to throw one up at you very, very shortly, in fact, in the next slide or two. We can have a look at alternative techniques which then may factor in things like our true cost of capital, cost of debt, cost of equity, variable discounting. If we're going to use a discounting methodology, and maybe that's what's inappropriate right from the outset anyway. And to assist in guiding development of alternative techniques, ideally we need further consultation with industry. Now, it might be sufficient to say that researchers should be doing this, but I can assure you that some of the ideas that researchers come up with may not be that practical in industry, and it will never be used. So that's a problem. So I said, that first, what's written in black on this particular slide, I've already gone through that, driving poor behavior. We need to address how we drive behavior. What I want to do, though, is in the last couple of minutes, is just to tell you around derivative instruments. Now, just to give you a bit of a background, yes, I'm an engineer and investment banking. I'm also driving a Perth Critical Minerals Exchange for Digital Finance CRC. And in this, one of our solutions to what we're proposing will incorporate derivative instruments. Okay, so I'm not trying to suggest that I've learned all of this around that. I've picked up all of this information through my days of investment banking. But my proposition would be to assist in understanding how you qualify and quantify mine closure, post-closure, is you can create derivative instruments. And in the first instance, we'd need to have a broader understanding of how these instruments can be used, what's their versatility, and what their benefits are. So there's an education process that needs to take place. But on the same basis, I'll say to you that, 70, 80 years ago, no one knew what a DCF NPV was anyway. So we've moved and now we fully understand it. So the more you use something, the better you get and the improved understanding you have of that particular thing, in this case, a derivative instrument. So please don't let the word derivative instrument throw you and say, oh boy, never going to use that. It's familiarity. That's all it is. The instrument, you can create one, you can develop one to address closure, post-closure. We can then have these instruments actually traded on an exchange for market transparency and for the market to recognize pricing. And when I say pricing, I'm talking about the potential benefits and liabilities associated with closure and post-closure. So the derivative instrument itself will be able to be exercised at a particular point in time, and it will address an activity rather than a value. So you exercise it to address your closure, post-closure specifics. In other words, your benefit and liability will be dictated by that instrument by its price over time. So the market is dictating the price. And in the market, you've got players who fully understand what closure, post-closure is all about, because you've got service providers, you've got astute investors, and sure, you've got the sort of moms and pops who are just trying to make a bit of money and go short, go long. You can do that with instruments, but at the same time, what you're doing is you're trading the instrument so you get value recognition. And the value recognition will ultimately manifest in what closure and post-closure benefits and or liabilities will be associated with that particular closure. That action on exercise could be something like recontouring or retopsoiling or waste treatment or aesthetics or build a hill or dam or whatever. And that's dictated by the instrument actually exercised. Quick diagram. So what is a derivative instrument? So if you've got a commodity and you've got a derivative contract, then quite simply, the value of your derivative contract is a function of the value of the commodity. It's the definition. A derivative is secured, or it's a security that derives its value from the underlying asset. You can have a derivative on a derivative, and this is probably where we'd have to go to. That would be, you'd have got your commodity, you've got your derivative, or this particular case, you've got an end of life. End of life, post-closure, closure, post-closure, you've got a derivative contract. We can put a derivative on the derivative, and we have the value of the derivative as a function of the derivative itself, which, as we know, is a function of that closure action. So that's the brief outline of what it is. The final two slides, and just give a few more words around how it might actually work. So you create the instrument and you allow it to trade. And that instrument would be exercised to look to an action. As I say, it could be to move 100,000 cubic meters of earth. It could be to address a acid mine drainage, in other words, neutralize water, it could, et cetera, right? You allocate a quantity or volume of each of the instruments. So you don't just have one instrument, you'll have hundreds of thousands, much like you have shares, and they will recognize varying degrees of difficulty associated with, say, moving 100,000 cubic meters. The value of the task, the actual activity, it allows the contractors to be paid for the dollar amount. So that's reflected in the security instrument itself. The activity is moving the 100,000 cubic meters, but someone has to get paid for that. That'll be your service provider. And on exercise, they actually get paid for it. An appropriate number of options need to be exercised to complete that particular task. The way it all pans together, so this is my penultimate slide. So the way you'd run this would be a mining company engaged with an investment bank, because they are going to write the instruments, and obviously they then get your intermediaries involved who trade the instrument to allow for value recognition. Value recognition in this particular case, I'm talking about activity recognition with an associated either liability and or benefit. So the underlying value is reflected in that instrument. So investors will trade it, allowing for value realization. Then as your operation heads towards mine closure, end of life, the mining company needs to ensure it holds a sufficient number of instruments. So it's not all the instruments. It holds a number sufficient to address its closure requirements or post-closure. And that's going to offset costs and also realize the benefits. If it does not do that, well, then it's just going to carry on funding closure, post-closure off its own balance sheet. So it's not as if you have to do it. It's an option. You can do it. But if you don't want to do it, you've got more likelihood of paying out more because at least the instrument is allowing for, as I say, value recognition. When you exercise, the holder of the instrument, they exercise and they say, right, we need post-closure cleanup or we need some activity performed. So the holder then says, I want that service rendered. At that particular stage, the holder is likely to be, say, the miner itself, or it could be a service provider already, because the service provider can trade these instruments too, because the service provider might say, well, I actually don't want to perform the service, and I will subcontract. So they then exercise instrument is exercised against the service provider, and the service provider exercises its own instruments that it holds in order to get a third party to provide the service. So there's ways and means, and that's why I say it's a derivative of a derivative. So absolutely easy to pull together. The value associated with the instrument is going to vary over time as your unknown unknowns trend towards being known knowns. I didn't give you much information on that, but anything that is an unknown unknown over a period of time, as the uncertainty morphs towards being a risk, we get to know it, and as an intangible morphs to becoming a tangible, we get to know it. And that's why unknown unknowns ultimately trend towards being known knowns. That, folks, hopefully hasn't confused you too much, but just giving you an idea of what could be used as a benefit or an alternative to DCF NPV. But our mandate was to look at what the issues are surrounding DCF NPV. There's my concluding slide, and I'm not going to run through that because you've heard enough of my voice already. So thanks very much. I'm going to stop sharing screen and happy to take any questions if there are.
Thanks, Eric. That was great. I certainly learned a lot. There are a couple of questions, so let's just start with this first question. Are there many published case studies to learn from in terms of projected closure costs versus actual costs? So the focus
Yes, there are.
Projected versus actual, yeah.
Yes, there are. So what you're looking for is reconciliation. But keep in mind that projecting closure costs is a morphing animal, that any mining company or any mining asset will look to mine closure as they start on day one with a mining operation. By the time they get to year 5, year 10, year 15, they have changed their views on what that closure may look like. So the reconciliation is continuously changing as the forecasting changes. But there is research out there that actually looks at day one. So I've just got the definitive feasibility study in place. I haven't started mining operations, and I'm already suggesting that my mine closure looks like a $100 million as an example. So on that basis, as you move forward, that $100 million changes. It could become $80 million or $120 million as time progresses, because you know more and more as you approach that closure. But to answer you simply, yes, there is reconciliation exercises that have been done, and certainly worth pulling out to have a look at how inaccurate we are, because that's all it is. It's degrees of inaccuracy.
Great. Thanks, Eric. So next question. Other than knowing about the defects in DCF analysis, what practical advice do you have for practitioners?
Okay, if that question says, I absolutely intend to continue using discounted cash flow NPV as my tool, then I would certainly be saying, please, one of the biggest issues you have is the discount rate. So it might sound like a pet hobby horse of mine, but this discount rate thing is absolutely massive. You think about this, a definitive feasibility study might take up to 2 years with all that exploration and all those consultants, 2 years to complete a definitive feasibility study, and that's a pretty quick one. And it might cost you, I don't know, 10 million, 40, 50 million, including all the drilling and assaying. So let's just take a number. Let's take 50 million. You spend $50 million on completing a definitive study, and you're going to build this mine. I pose the question, how long does somebody take looking at the discount rate to say, well, with that entire 2-year, $50 million feasibility study, I'm going to apply an 8% discount rate. And what you've gone and done is you have gone and taken that entire study and made a rubbish out of it, truthfully, because your contemplation of just using some willy-nilly 8% because that's the company's return has gone and effectively null and voided a full chunk of what you've done in your study. So look at your discount rates, understand how variable discounting works, strip right down to cost of capital asset pricing model for equity, your cost of debt, and then determine over what periods of time you get this gearing change within your cash flow so that you can actually move towards a variable discount rate. It's an important piece. It really is.
Okay, awesome. So the next question is, using markets to trade and signal price of closure derivatives is a really interesting approach. How deep or liquid would the market need to be to reflect true price or cost via trading?
Right. So as I said, your liquidity is going to be dictated by how many mining companies want to hold the instruments themselves. But remember that the instrument itself has got inherent value to trade. So in the first instance, it's not the same as holding a stock in a company where you think, all right, the liquidity of, say, BHP Billiton, maybe that's a bad example, but of some of your smaller stocks where you've got management holding 40, 50%, so your liquidity is actually not that great. These instruments are going to be trading for investment purposes, for returns. So anybody and everybody will trade. Yes, you are going to have mining companies holding on to them as well. But how many mining companies are there? There are hundreds. So they're going to have to trade. You've also got service providers who want to hold some of these instruments, so it has to trade. You've also got governments who should be holding these instruments as well, so they're going to have to trade. And you might say, well, hang on, once they've got it, they're not going to trade. And my answer to that is they will trade. And the reason is because mines are inevitably going to close. And a mining company doesn't want to hold on to a whole host of the instruments for 50 years. The instruments themselves are partly investment, but the investment value is realized on trade. So even your mining companies are going to want to trade these instruments. So I do not believe that liquidity is actually going to be an issue.
Okay. Right. So next one, many of the shortfalls you point out in NPV are limitations in our knowledge of the future. We need to make decisions between closure options in a space of uncertainty. NPV calculations are simple and the basic mechanics are widely understood. Even if they are not providing a true answer, they provide a quick way to discern between options. How would market dynamics support decision-making in a space of uncertainty?
Fair question, and you're 100% correct. It's the familiarity with DCF NPV that we continue using it. So why would we change something we know and we've trusted for so long? So even where we know what we don't know with what DCF NPV can and can't do, we say we're going to carry on using the methodology because we know that it is only 40% accurate or 60% accurate, but at least I know how inaccurate it's going to be and I can adjust and accommodate that. And as I say, I get away from the principle of saying, why should we be accepting something that is not perfect? I'm not saying that derivative instruments are perfect either, but they'll be far more accurate. And over time, we can evolve and create something. Maybe it's even something associated with how DCF NPV works that becomes embedded in closure post-closure such that we can trade whatever we perceive to be the outcome associated with that, that particular methodology. So yeah, there are limitations, without a doubt. And everyone here has to recognize that there are limitations, but there are limitations to anything and everything we do, including things like derivative instruments. And what we're trying to do is we're trying to minimize the limitations. So we look towards the uncertainties, and that was thrown into the question. So how do we look to those uncertainties? Well, the reality is you can model scenarios around uncertainties, but as long as you're using a DCF NPV methodology as modeling those uncertainties, you're basing it on an inaccurate methodology anyway. So I'd be questioning not so much about the uncertainties, but the way in which you're trying to define, qualify, and then quantify those uncertainties. So until we can get our mind around familiarization of alternatives, things like derivative instruments, and I iterate, I get nothing out of it. I'm not trying to say derivative instruments are your answers. I'm trying to suggest he has an alternative that needs to be given further thought. And with further edification and understanding, we'll figure out very quickly that they're not as frightening as they are. And they do address uncertainties. So again, ipso facto, the methodology itself, DCF NPV, improperly and inadequately addresses those uncertainties.
Okay, great. So the next question follows on from uncertainties, actually. Do the uncertainties you mentioned earlier also account for potential opportunities, particularly related to ESG factors? For instance, if a mine's processing plant chooses to use hydropower instead of coal power, it may improve ESG performance throughout the mine's life.
Absolutely correct. And therein lies one of your fundamental challenges with modeling on a DCF NPV basis, because if you look at the benefits of, say, hydropower post-mine life, what are you doing to the benefits? You're going to discount whatever those benefits are because ipso facto, again, that's what DCF NPV does. It's all about discounting to get to current day, real, and risk mitigated view. So you're already dealing with an inaccuracy. Should we not then just say, okay, take our discount rate to zero? Well, you've got a fundamental issue there anyway, because things like, or specifically, your sovereign risk is not diversifiable. As long as you're in this country or any country, you've got exposure to undiversifiable country risk. So you're going to have to use at least the risk-free rate of interest. And now you're still discounting a benefit, but we don't know how great that benefit is. So then do you consider, well, what I'll do is I'll model the upside at the end of life on the hydropower, and then look at that and say, well, the benefit today is that. But if you're doing it in DCF NPV, I iterate the point, you're discounting it. Whereas if I said to you, I've got a derivative instrument that has a strike price of whatever, what will happen over time is there'll be recognition to the fact that that hydropower, post-mine use, post-mine land use, or post-closure, will have that benefit. And a derivative instrument is not discounting what that value is. It's actually probably enhancing and recognize the option value associated with that particular utilization. So yeah, a very fair question, but I think the answer is DCF NPV is still a problem.
Great. So at the moment, it's one last question, but if anyone's got any additional questions, put them in the chat as we're reading this one out. So has the approach of creating and trading derivatives been tested? Is this an opportunity to test or experiment with prediction market style experiment in real time?
Again, very good question. Derivative instruments are traded around the world, so that's a given. We know how they trade. We know that they do trade. We know that options, puts, calls, butterflies, they trade. Does a specific instrument or an instrument specific to what I'm trying to suggest, in other words, closure, post-closure, does that exist today? The answer is no. But let's look back at what happened with Lehman Brothers. Let's have a look at back what happened to the GFC, the global financial crisis. How did that all come about? It was the derivation or the creation of derivative instruments that took a bunch of absolutely, excuse the language, I won't use the language, of really shocking exposures as far as mortgages and house values and home values, packaged together, got a credit rating of, investment grade rating from Moody's and Standard & Poor's and Fitch, and suddenly you had this basket of rubbish that was trading at a value. And then one day markets woke up and said, oh, the properties aren't actually worth that much. And you could not deliver on the instruments because the underlyings had lost their value. That is a derivative instrument, and that was created specifically for a circumstance. And my point is that instruments are being created all the time. And I'll tell you right now that the Digital Finance CRC created an instrument about a year ago that even the Reserve Bank of Australia, RBA, endorsed. They agree with it. And it's currently in prototype phase, but it's been developed. And all I'm saying is give this kind of opportunity a platform on which to trade. Now, I can iterate that this is not a personal drive of mine. It's the Digital Finance CRC. So any instrument that's created will have to be vetted by the tax office, by the RBA, by the various regulators, because the last thing we're going to do is create an instrument that causes angst and losses and very deliberately takes money away from people. This will be an investment instrument. So it'll go through the usual regulatory panels, ASIC, etc., shareholders, stakeholders, through ASX as well, and we might create a new platform, it doesn't matter, a specific exchange for these tradable instruments, much like we're doing for Perth Critical Minerals Exchange, which is the Digital Finance CRC, but it goes through all the regulations such that it is absolutely above board. So your protection mechanisms will be sitting there. It does come down to the standard risk of how risky is trading shares, or how risky are you prepared to be exposed to trading options or derivatives. That becomes a personal choice, but the market needs to be created for it. And are there markets for closure, post-closure instruments right now? The answer is no. But just because we haven't seen that already in place, must we as Australia sit back and let someone else do it for us when we are some of the biggest miners in the world? We move earth. That's one of our core functions within Australia from a natural resource point of view. So why aren't we innovative in terms of what we do at closure, post-closure stage as well?
Right. Well, there is one last question which does relate to that, I think. I'm going to slightly interpret the question following on from your words. So if you do have a worked example of a derivative that is closest to the sort of thing that you're talking about, that you would be able to share, people would like to have access to that. If you have something that you can share when that's available, or if there's something you can share now, which is a sort of a worked example of something similar, people would be keen to see it.
Okay. I haven't got one at my fingertips, but the knowledge to put something together from a hypothetical point of view that will ultimately be what we'll test case, or we'll test out with the various regulators. That kind of thing to put together is not a difficult process. So yeah, I'm sure I can throw together some diagrams and how this mechanism will actually work, and the trades, all the way from your writers of the derivative instruments through to your traders, and then how on exercise will this actually manifest and what does it do. So yeah, and how the pricing mechanism might actually work with volatile markets over time, and you get the move from unknown unknowns to ultimately to known knowns. I think I'm sure I can pull something together on that.
So if people are looking for that, maybe if they can just contact CLC Time at the hello@CLCtime address, then we can forward that to you, or you can forward to us, and we'll forward it on.
Yeah, they're absolutely fine. And Tom, your colleague Brian Maybe, who is not here today, he and I, well, we work right next to each other, and we often bounce some of these wonderful ideas off each other. So if the question sort of gets passed through Brian, that's equally fine. I'll probably share the concept with him in any event, because I'm sure we'll have a lunch or two where we discuss and thrash through the machinations of it. So don't mind if if you keep Brian in the loop or whatever. However, I'm not suggesting how you run CRC. That's that's your business.
Great. Well, look, thanks so much, Eric. It was a fabulous seminar. I know I learned a lot, and I'm sure everyone did online as well. So thank you, and see you all again for the next webinar. Okay. Bye-bye.
Been a pleasure. Cheers.